This is a difficult question to answer, so forgive me. We go straight to the realm of speculation. But if you had to guess what the FOMC looks like in the month of June, what would you guess it's going to look like?
I assume that somebody's going to blink. Either the Trump administration is going to withdraw their investigation of the renovation of the headquarters building, or Tom Tillis is going to decide that he will align himself with the Republican majority in the Senate Banking Committee and vote to affirm Powell. But we're not sure. And if they don't, if Tillis doesn't withdraw his objection, if the Trump administration doesn't stop the probe, then it's very likely that Powell will stay on as the acting chair. At that point, Trump has threatened to fire Powell as the acting chair, and it's not clear legally whether he has the authority to do so. So it's a bit of a mess. It obviously makes the job for Kevin Warsh also more difficult, not just because of delaying, potentially his taking over from Powell, but also he's going to be viewed with quite a bit of skepticism, I think, by the rest of the committee. Is he there to do what's appropriate for the Fed in terms of the conduct of monetary policy, or is he there to do the president's bidding?
So, Bill, these are important questions, and we all take seriously the threat to central bank independence. But I think we also take comfort from how well anchored inflation expectations have been throughout all of this. Do you see anything on the horizon that might upset some of that?
Well, inflation's expectations are anchored in part because people think the Fed will do the right thing. So it's not independent of the Fed's behavior. So I think that people would be very upset, I think, if Powell is somehow fired and it goes into the courts and it has to be adjudicated. Kevin Warsh, I think, is going to have to win the hearts and minds of the rest of the Federal Open Market Committee. I think it's very unlikely that the Fed's going to cut rates in June. I think with the headline inflation going to be close to 4% on a year-over-year basis, then I think the sentiment is going to be to watch and wait, and in part to ensure that inflation expectations do stay well anchored.
We saw yesterday Treasury Secretary Scott Bessent came out and took the heat off of Kevin Warsh should he become Fed chair by May 15th, as is expected, or at least scheduled, saying that he would understand if the Fed needs to wait on rate cuts, even if he ultimately saw large cuts beyond that. How do you see a Treasury-Fed accord working together to shrink the balance sheet and reshape the way that the Fed controls rates at the front end and the shape of the curve?
I don't think they're going to change how they execute monetary policy. I think they're going to remain in a regime where reserves are above the supply of reserves are above the demand for reserves. What I think they're going to do is make some changes structurally that reduce the demand for reserves. And if the demand for reserves can come down, then the supply of reserves can come down and the balance sheet can shrink. But I think what's probably being exaggerated a little bit is how much restraint that will cause. If you shrink the balance sheet by, say, $1 trillion, which is probably the order of magnitude that we're talking about, it's going to exert very little real restraint on the economy. So the idea that balance sheet reduction can lead to dramatic declines in short-term rates, I just don't think that's credible.
I remember back in 2021, you came on the show and you said that 10-year yields could be at 5%. You could see Fed funds rates at 5%, given the inflation building in the system. Right now, do you think that people are overly sanguine with just how much inflation is building in the system as a result of the commodity shock stemming from the Middle East?
Well, I think that it's correct for the Fed to think of this as a temporary shock, that energy prices are probably going to go back down in the fullness of time. But I think they're constrained for two reasons. Number one, we've been missing the inflation target to the upside for 5 years in a row. So every month and year you stretch that out, there's more risk to inflation expectations. And number two, the Fed's independence is under attack. If the Fed's independence was not under attack, the risk to inflation expectations would be significantly lower.